Hello and welcome. Today we are diving into the fixed range volume profile, a tool that can really help traders get a better understanding of market dynamics. We will cover what it is, how it works, and why it can be such a powerful tool for anyone looking to improve their trading. By the time we are finished, you will have a solid understanding of how to use this tool to identify key price levels and make better decisions when you are trading. Before we dive into all the details, let me ask you this. What if you could see exactly where most traders are stepping in to buy or sell, giving you an edge in identifying those critical price levels? Let us start by breaking down what exactly the fixed range volume profile is. Imagine that you have a tool that can show you where most of the buying and selling happens at different price levels. Unlike other volume indicators that just tell you how much trading occurred over time, this tool shows you where the trading happened on the price scale. You can see exactly where there was a lot of interest from both buyers and sellers. This helps you know where important price levels might be and why they might act as support or resistance. Additionally, recognizing different chart patterns in combination with the fixed range volume profile can greatly enhance your analysis. For example, when you spot a head and shoulders pattern forming near a high volume node, it could indicate a strong reversal is likely. Similarly, a double bottom or double top pattern appearing at significant volume levels can confirm a potential reversal or continuation of the trend. Patterns like triangles, wedges, and flags can also provide more context. If these patterns form in low volume areas, they could signal a quick price movement upon breakout, whereas in high volume areas, the movement might be more contained or consolidate further before breaking out. Learning to recognize and utilize these common patterns along with the volume profile can give you a much deeper understanding of the price action and potential market moves. Think about it this way. When you see a lot of volume happening at a specific price, that means a lot of traders were interested in that level. Maybe they thought it was a good deal, or maybe it was a fair price. Either way, this tells us something important about that level. It might mean that the price is likely to react if it returns to that level again. You could see a bounce off that level or perhaps a breakout. All of these things are what make the fixed range volume profile so useful. Once we apply the fixed range volume profile to a chart, we will see horizontal bars across different price levels. The longer the bar, the more volume was traded at that price. This gives you an easy visual to tell at a glance where a lot of trading happened. You will also notice areas with short bars, and these represent places where not much trading took place. Knowing both of these areas can help you anticipate what might happen next. High volume often means strong support or resistance. Low volume can mean that price will move quickly because there is not much interest there. It is also helpful to recognize and understand various chart patterns that occur in conjunction with these volume levels. For instance, when you see a double top pattern forming at a high volume area, it is a strong indication of a potential reversal. This is because the high volume area represents strong resistance and the double top shows that the price is struggling to move past it. Similarly, a double bottom pattern forming at a high volume area can indicate a potential support level that is holding, which might signal a reversal to the upside. Another example is when you identify ascending or descending triangles in the chart. If these patterns form near a high volume node, the outcome of the triangle pattern, whether a breakout or breakdown, can be even more significant. The high volume at these levels indicates a buildup of trading interest, and once price breaks out of the triangle, the movement is often accompanied by increased momentum. Wedges are also important to watch. Falling wedges in particular can be bullish signals, especially if they form around a high volume support area. Rising wedges can be bearish, especially near high volume resistance levels. Combining the pattern analysis with volume information gives you added confidence in predicting the direction of the breakout. Flags and pennants are also continuation patterns that can give you a lot of information when combined with the fixed range volume profile. If a flag or pennant forms after a strong move and aligns with low volume areas, it could mean a quick continuation of the move once the price breaks out of the pattern. On the other hand, if the flag forms at a high volume area, the price might face resistance and require more time to break through. By understanding these chart patterns and integrating them with the information provided by the fixed range volume profile, you can make more informed trading decisions. It helps you see not only where significant trading activity has happened, but also what kind of price patterns are developing at these levels, providing more insight into potential price movements. Now let us get into how you can actually set up the fixed range volume profile. To get started, you will open up your chart on whatever trading platform you like to use. Pick an asset or a market that you want to look at, maybe one you are trading right now or one you are just interested in. Once your chart is open, find the section where you can add indicators. You will need to look for something that says fixed range volume profile or something similar. After you select it, you will then need to decide what time or price range you want to analyze. This can be a trend you have noticed, a period of consolidation, or just any part of the chart you want to understand better. Drag the tool across that range and you will see the volume bars show up right on your chart. When it comes to reading these volume bars, your goal is to look for the longest ones first. These are the high volume nodes. These are the areas where the most trading took place, and they often act as key levels for support or resistance. When price approaches these areas, you can expect some sort of reaction. The price might stall or reverse because there was so much interest there before. Let us also discuss the types of chart patterns that can often be identified when analyzing these high volume nodes. One of the most common patterns you will see is the head and shoulders pattern. This is a reversal pattern that forms after an upward trend and is characterized by three peaks, with the middle peak being the highest. If this pattern forms at a high volume node, it suggests a strong potential for a reversal because the high volume represents significant resistance that the price is struggling to overcome. Another important pattern is the cup and handle pattern. This is typically a bullish continuation pattern that resembles the shape of a teacup. When this pattern forms near a high volume support level, it can indicate that after a period of consolidation, the price may be preparing for a strong breakout to the upside. The high volume in this area confirms that there is significant buying interest. Descending and ascending triangles are also worth noting. These patterns indicate either consolidation or continuation depending on their direction. When an ascending triangle forms near a high volume node, it suggests strong buying pressure that could eventually lead to a breakout above resistance. Conversely, a descending triangle forming at a high volume node indicates that selling pressure is mounting and a breakdown might occur. Another key pattern to watch for is the rising wedge and falling wedge. A falling wedge in a high volume support area is often seen as a bullish reversal signal. This pattern forms as the price makes lower highs and lower lows, but the narrowing range indicates that sellers are losing control. If the wedge forms near a significant high volume node, it reinforces the idea that a reversal could be imminent. Paying attention to flags and pennants can also be very helpful. These continuation patterns are characterized by a strong price move followed by a period of consolidation. If a flag or pennant forms near a high volume area, it often indicates that the price will continue in the direction of the initial move. The volume levels give additional confirmation by showing that interest remains high at those levels, supporting the continuation of the trend. Finally, you also want to pay attention to the shorter bars. These are low volume areas, and when price gets into one of these areas, it often moves quickly. This is because there is not much interest from traders at those levels, so price can glide through them without much resistance. Recognizing these patterns and understanding their relationship to volume levels can help you anticipate what the price might do next, whether it is a breakout, a reversal, or a rapid movement through a low volume area. Another key part of this tool is what we call the point of control. The point of control, or POC, is simply the price level that has the highest volume traded in the range you are looking at. It is important because it shows where the most action happened. It can tell you where buyers and sellers are the most committed. When price is near the point of control, there is often a lot of activity, and it can be a good level to watch for potential reversals or breakouts. Now, let us talk about some strategies for using the fixed range volume profile in your trading. One of the main ways is to use those high volume areas as support or resistance levels. If price is moving towards a high volume area, you might expect that it will react. It could bounce off that level, or if it breaks through, it might move strongly. On the other hand, if the price is moving through a low volume area, it is likely to do so quickly. This is a great opportunity to catch a breakout move if you are paying attention. You can also use the fixed range volume profile to help confirm a breakout. Imagine that price breaks through a high volume area with a lot of strength. This could mean that the breakout is real and price might continue to move toward the next significant volume level. However, it is crucial to consider the type of chart pattern forming alongside the volume activity. For example, if a breakout occurs following the formation of an ascending triangle near a high volume area, it strengthens the likelihood that the breakout will have sustained momentum. Similarly, a symmetrical triangle or bullish flag pattern appearing near these nodes can suggest that the price is preparing for a larger movement in the direction of the breakout. Additionally, it is essential to watch for any failed breakouts. Sometimes price will attempt to break out of a high volume area, but lack the momentum to sustain the movement. This is where recognizing reversal patterns, such as a head and shoulders or a bearish engulfing candlestick, becomes important. If such patterns form right after a failed breakout attempt, it could mean that the price is more likely to reverse rather than continue. By paying close attention to the volume profile in combination with these chart patterns, you can make more informed decisions about whether the breakout is likely to succeed or fail. Watching how price behaves around these high volume nodes can help you decide whether a move is likely to continue or reverse, providing greater insight into future price actions. Another useful way to use the fixed range volume profile is for setting up stop-loss orders or finding entry points. If price is approaching a high volume node but does not seem able to break through, it might be time to take profits or consider entering in the opposite direction. These levels can help you get in or out of trades with a little more confidence because you know that many other traders are also paying attention to these key areas. You can also combine the fixed range volume profile with other indicators to make it even more effective. For example, if you are looking at moving averages along with your volume profile, you might notice that price reaches a high volume node and crosses above or below a moving average. This can give you extra confirmation about the direction the price is likely to take. Moving averages, whether simple or exponential, can help highlight the overall trend direction and act as dynamic support or resistance levels. Another great combination is to use the relative strength index, which helps you see if a market is overbought or oversold. If price reaches a high volume node and the relative strength index is also showing an extreme, that might be a very strong signal that a reversal is coming. Furthermore, combining divergence analysis with the RSI and volume profile can add even more insight. If price is approaching a high volume area and the RSI is showing divergence e.g., the price makes higher highs, but RSI makes lower highs, this could be a strong indicator that the trend is losing momentum and a reversal is likely. Bollinger Bands are also a good tool to combine with the fixed range volume profile. When you see price reaching a high volume node at the same time that it hits the edge of a Bollinger Band, this can tell you that a breakout or reversal is more likely. Bollinger Bands help you visualize volatility and can signal when price is likely to revert to the mean. For example, if price reaches a high volume node and simultaneously touches the upper Bollinger Band, it could indicate overextension, making a pullback or reversal more probable. Watching for these combinations can help give you more confidence in your trades. Another valuable combination is the use of candlestick patterns alongside the volume profile. For example, if price approaches a high volume node and forms a reversal candlestick pattern, like a hammer or shooting star, it can provide a clear indication of a potential price reaction. Engulfing patterns at high volume areas can also be very powerful. For instance, a bullish engulfing candle at a high volume support area can indicate strong buying interest and a potential reversal to the upside. Finally, using the average true range ATR along with the fixed range volume profile can help you determine the best place for stop-loss orders. The ATR provides insight into market volatility, allowing you to set stops that are not easily triggered by normal market fluctuations. If price approaches a high volume node and the ATR indicates high volatility, you might want to set your stops a bit wider to avoid getting prematurely stopped out. Combining the fixed range volume profile with these additional indicators, such as moving averages, RSI, Bollinger Bands, candlestick patterns, and adder, provides a holistic view of the market. Each tool adds another layer of analysis, making it easier to gauge where price is likely to react, trend, or reverse, ultimately improving the quality of your trading decisions. Bollinger Bands are also a good tool to combine with the fixed range volume profile. When you see price reaching a high volume node at the same time that it hits the edge of a Bollinger Band, this can tell you that a breakout or reversal is more likely. Watching for these combinations can help give you more confidence in your trades. Let us walk through an example. Suppose that you are looking at a market that has been moving sideways for a while. Price is bouncing around in a range, not really going up or down in any strong way. You apply the fixed range volume profile and you see that most of the volume is concentrated near the bottom of this range. Then, suddenly, price breaks out above the range with a spike in volume. This can be a good indication that the breakout is real and that price will continue in that direction. Now let us think about a trend reversal example. Suppose you have been watching a strong upward trend and you want to see if it will continue or reverse. You apply the fixed range volume profile from the start of the trend to the current price. You see that price is now approaching a high volume node, but it is struggling to move through it. This could be a sign that the trend is losing strength and that a reversal may be near. Watching how price reacts to these high volume levels can help you catch a change in trend before others do. There are some common mistakes that traders make when they are using the fixed range volume profile, so let us talk about those for a moment. One mistake is putting too much focus on the volume profile alone without considering other parts of the market. Volume is important, but it is just one piece of the puzzle. Make sure you are also watching price action and using other indicators to confirm what you see. Another mistake is ignoring the low volume areas. These low volume zones are where price can move very quickly, and this can be a big opportunity if you are looking for breakout trades. Do not overlook these areas because they can be just as valuable as the high volume ones. The way you use the fixed range volume profile will also depend on the type of market you are looking at. In a trending market, this tool can help you find strong support or resistance levels that might cause a trend to slow down or reverse. When you notice chart patterns like flags, pennants, or wedges forming in a trending market near high volume nodes, this can further enhance your confidence in predicting trend continuations or reversals. For example, an ascending triangle forming during an uptrend at a high volume node often signals that the trend has the potential to continue with strength, while a head and shoulders pattern at a similar level might indicate an upcoming reversal. In a range-bound market, it can help you figure out where price is most likely to turn around, especially if you are watching the point of control and the high volume areas. Chart patterns like double tops and double bottoms are particularly relevant in these markets. A double bottom forming near a high volume node within a range often indicates strong support and a potential bounce, while a double top suggests significant resistance that could lead to a reversal. If the market is volatile and moving quickly, the volume profile can help you spot places where the price is likely to pause and stabilize, giving you a better idea of where to get in or out. Patterns like symmetrical triangles can also be useful in these conditions. If such a triangle forms near a high volume area, it can signal that the price may soon decide on a direction, giving you an opportunity to prepare for either a breakout or a consolidation. Understanding these patterns and their interaction with high and low volume areas can give you an edge in any type of market environment. As we wrap up, let us recap what we have learned today. The fixed range volume profile is a powerful tool for spotting key levels on a chart, finding potential breakouts, and identifying where a reversal might happen. It takes some practice, but once you understand how to use it, it can really make a big difference in your trading. Try applying it to some charts, experiment with different ranges, and see how it fits with your trading style. The more you use it, the more you will see how useful it can be. Keep an open mind and keep practicing, and soon it will become an important part of your trading toolkit. Remember, trading takes time to master, and tools like the fixed range volume profile are just one part of the process. If you have questions or want to share your thoughts, do not hesitate to ask. We are all learning together, and sharing ideas can make us all better traders. Thank you for joining today, and I wish you all the best in your trading journey. Keep practicing and stay curious.